Today we're talking about a company that is trading at a significant discount to its historical valuation. The company that represents a massive opportunity. It's at the top of its field. It is a cash generating monster. Today we're talking about Canadian Natural Resources Limited, ticker symbol CNQ. One of the best companies in the Canadian energy space and one of my personal favorites that we've talked about here on the channel. I'm going to take a deep dive into CNQ. We're going to talk about exactly why I believe they're undervalued. We'll talk about the story. We'll talk about the numbers. We'll talk about projections. I'll outline a bull case and a bear case for this company, what I think may happen in the not so distant future. We'll talk about why for a long-term investor who's willing to hold 5-10 years, this could be a life-changing investment. Let's dive into it. Welcome to Gold Arch Investing. My name is Liam. On this channel, we love to talk about Canadian investing. If that interests you at all, please do like the video, subscribe to the channel. It makes a massive difference and it doesn't cost anything. All right, I'm going to jump over to Canadian Natural's investor relations page here, and there's a lot of really interesting information here. Now, they have a little section talking about who they are, what they do, right? They talk about what they operate, and it really does break down into these three sections, right? Natural gas, light crude oil, and NGLs. Heavy crude oil, oil sands. If we jump into natural gas, they're one of the largest independent natural gas producers in Canada. I think they're technically second place as of right now. That's not always the case, right? There's lots of other competitors, but right now they're second place in Canada. They do also produce a good amount of light crude oil in North America. They also have some development and exploration opportunities in Côte d'Ivoire, which is offshore in the west coast of Africa, and they have some operations in the North Sea. They also produce a large amount of heavy crude. They're one of the largest heavy crude oil producers with significant opportunities in primary heavy crude oil at our world-class polymer flood asset at Pelican Lake. And of course, like I said, the headliner here, oil sands. They have a massive amount of oil sands assets, like world class, 7.5 billion barrels of company gross proved plus probable SCO reserves, which means no declines for over 50 years, mined oil sands, bitumen products, and upgraded. 90% working interest in Muskeg River and Jack Pine, 100% owned and operated Horizon and Upgrader, mined oil sands upgraded at 90% owned Scotford, and carbon sequestration via 90% owned Quest Carbon Capture and Storage Project at Scotford. So they have a lot of really interesting assets that make them a really interesting company. And if you're at all interested in the energy space, of course, you know all about them. Now, I wanted to jump into some of the numbers here because I think this is a really important part of the discussion. When I'm talking about undervaluation, to understand that we need to see, all right, what does valuation normally look like? So if I dive into the numbers, they're currently valued at $80 billion Canadian, puts them at a trailing 12-month PE of 13.3 with a next 12-month PE at 10.1. If you look at the price target right there, I think that's a really important number. The price target over the next 12 months is $51.53, which represents a $12 improvement in share price over the year, which would be fairly significant. You got a 1.1 PEG ratio, so price to earnings growth ratio, which I think looks really nice, 8.7 price to free cash flow. One of the big things you need to look at with this company is their growth numbers. So revenue 5-year compound annual growth rate at 9%, which looks really good. Diluted EPS is coming in about 5%. You look at their forward 2 years for EPS, they're expecting it to go up quite a bit. Revenues, they're expecting to continue a little bit slower. And then, of course, dividends, one of those really important metrics for a lot of us that are planning on holding long-term. They currently have a dividend yield of 5.3%, got a payout ratio of 74%, and their dividend growth over the last 5 years is a 23.3 yearly improvement. So quite impressive dividend growth over the last short while, but obviously we see that payout ratio somewhat high. Now, I mentioned it's really important to look at the industry, and so I'm going to jump over to the industry tab on FinChat, and I just want to look at forward PE. I think that's one of the most important metrics, and FinChat does a fantastic job of outlining this for us as investors. They do show us a lot about the industry, and they pick out competitors, but I've also put a couple of names in here myself. And so let's see. Forward PE for CNQ, again, we mentioned 9.7. Obviously, much lower than Enbridge, much lower than TRP, than SU, than IMO. SU and IMO, Suncor and Imperial, of course, those are the two sort of most well-known majors in the Canadian industry, which are both not significantly, but definitely a little bit higher priced. We go into the CVE. Synovus is a little bit lower. Tourmaline is a little bit lower. ARC, quite a bit lower. but these are all smaller companies. So definitely interesting. They're sitting sort of in that range in the industry. However, I think their size means they should be trading up. If you look at Enbridge, right, that's like name brand. If you're somebody who knows nothing about Canadian oil, you probably know Enbridge. And yet we're only seeing them trade at a 20, which is not that insane considering Pembina, which is a much smaller, maybe less known, maybe less held Canadian pipeline stock, is trading at a 16.7. A lot of really interesting things here. Now let's look a little bit at some performance numbers. So over the last 5 years, the performance has been absolutely fantastic, but we do need to keep in mind that 5 years ago was April of 2020. We're not quite at the lows anymore, but we're still down in that COVID crash era. And so comparing that to today's price is maybe not fair. A more fair metric would be over the last 3 years. And here's where we start to see some of the undervaluation argument come into play. If you look at the last 3 years and you think about the growth this company has experienced, we're seeing the share price right now lower than it was 3 years ago in April of 2022. Now, in part, that's because of the price of oil, considering that back in April of 2022, we were still seeing quite a bit of shock from all of the conflict going on. Of course, you had the conflict in Ukraine. You had all sorts of sort of supply chain issues. You had all the inflation fears. The price of commodities spiked, and oil was one of those commodities that spiked hard. So they made a lot of money off that. But still, you're seeing basically no growth over the last 3 years. The last 1 year looks even worse. 1 year ago, the stock was priced at $53. Today, we're priced all the way down at $38. That is a brutal drop in price. And of course, is a big part of why I think it's worthwhile looking at where this company sits today versus where it sat just a while ago. Here's where I want to do a bull and bear case for CNQ. I want to keep this short and sweet. My bull case for this company, based on what I see coming in the next 5-10 years in the industry, includes an expansion of Canadian infrastructure, which brings the WCS price up to the WTI price, or at least within the range of about $1. Includes a decrease in US shale oil, allowing for an increase in cost of WTI, which then, of course, brings up WCS with it, and includes Canadian Natural using their size to expand within their industry to gain more long-term oil sands assets and monetizing those assets well. Either being, other companies coming in, so other investors coming in, putting money into this company specifically, allowing them to acquire, maybe some sort of dilutive effort, allowing them to acquire more instantly accretive cash flowing assets that then propel them to be by far in a way the largest name in this sector. I think this is a very reasonable bull case, and I think we could see this representing a double or triple up in the next 5 to 10 years. Now, that's not an insane gain when you compare it to what tech stocks have done, but in this industry, if we saw this company double or triple, that would represent somewhere in the range of 160 to 240 billion dollars Canadian, making them by far and away the biggest Canadian energy company and far bigger than any Canadian energy company is today. I think this would depend in a great deal, let's say, on the infrastructure being built, which they have no control over, and on US shale oil actually being at a peak, which based on experts is sort of debated right now. But in that bull case, you could see a huge amount of gain. The bear case for this company, no infrastructure gets built at all. And in fact, the next government is very bearish on the Canadian oil and gas sector and does not support them. It includes other companies coming into the space and outperforming. So big multinational oil companies buying up assets and performing faster, better, more efficiently, more advanced. And it includes global oil prices dropping thanks to a reduced amount of conflict or an increase in OPEC plus production or an increase in other sources of Canadian or non-Canadian oil and gas. In this case, I think you could see the company's share price stagnate for the next couple of years. I think maybe you could see cash flow levels start to drop. and you would see, investors lose a little bit of money with very little potential for big gains. Now, the question every investor has to ask ourselves, which of these things do you think is more likely? I've given a very bullish case with some quite high price targets and a very bearish case that maybe my price targets are a little optimistic for. But there's somewhere in that range is what is likely to happen over the next 5 to 10 years. I think we're probably going to see high middle of that range. So you're likely closer to a 2x than a 3x over the next 5-10 years. But again, it depends so much on things this company cannot control. So what can they control? Well, it's what they've been doing. They've been expanding their asset base. They've been expanding their balance sheet. They're fortifying the company. They're focusing on key assets, and they are producing a resource that is really quite in demand right now. With LNG Canada coming online, they have a huge potential in the sort of short term, sure, but they depend on so many factors they don't control in the medium to long term, and it will really be interesting to see how it plays out. I'm a strong believer in this company. I think they've proved to us that they can perform really well, and I think they will continue to outperform in the next 5-10 years. I think by 2030, it will have sort of demonstrated which way this trend is likely to go, and you'll be able to maybe make a better investment decision on the back half of the trend. But I am going to be building a position to try and build up as much of a base in this company as I can, because I think it really is a fantastic opportunity. Thanks for watching the video. If you made it this far, please do like the video, subscribe to the channel. It makes a massive difference and it doesn't cost anything. And let me know your thoughts in the comments down below. Do you like this company? Do you think they're worth the investment? Do you want to dive deeper into them? Do you want to hear more about them? Or are you interested in some of those smaller names that might have some faster potential over the next couple of years? Let me know in the comments, and I'll see you in the next one.